Hello, Stephen. Welcome to Japan. It's very nice to have you here.
Thank you very much for having me. It's great to be here.
Perhaps I should first ask you about your investment team, where you are, how your investment team works, and so on.
Yeah, absolutely. Well, thank you again for being here. So look, we work for Invesco in Henley in the UK, which many people may not have heard of Henley. It's, I think there's about 15 or 20,000 people in Henley. It's a very, very small town. It's a small market town on the River Thames, about an hour west of London. And the business has always been there, and the reason was when it was founded in the 1970s. The reason was to try and get out of London and be away from the noise and the sort of hubbub that's created in markets, and really think more deeply about the companies and the portfolios, and really focus on long-term investing. Now, so in the Henley office, we run about £50 billion of client money in fixed income and equity and multi-asset. And I think one of the really important parts of the Henley office is we have all of the regional teams in Henley. So for us as global investors, that's really helpful to have regional specialists that we can go and talk to about what's going on in their markets. Obviously, we talk to the fixed income and the multi-asset team as well about some of the issues that they're seeing. If there's a kind of credit market event, going and having a really experienced fixed income team is super helpful. And the other point I would make is I think it's quite different to many places. We have a very long tenure of staff. So I've been there 20 years, which in the asset management industry is a long time to be working somewhere. But I've been there 20 years, and many of the colleagues who were there when I started are still there. Even on my team, there are people that we recruited sort of 10, 15 years ago who were there, and they feel like they're quite new almost. And I think that creates a very powerful, virtuous circle of trust and understanding, and a very strong investment culture where everyone is trying to do a very similar role, and therefore can help each other in different market conditions.
Okay. You are trying to identify stock with three pillars, namely price, quality, and cash flow. Can you please explain that?
The quality aspect is one, and they have to be good enough. Cash flow, again, as you mentioned, is really important to us. So companies that generate cash as a sort of portion of their earnings, and generating that cash to reinvest in the business, grow the business, and also pay out to shareholders via dividends and share buybacks. And then finally, price, and that touches on the valuation point that you made. We want to buy companies when they're at a discount to our view of their intrinsic worth, and often that leads you to buy companies where perhaps there's some controversy around it, some short-term issue, some macroeconomic concerns, something like that drives the valuation down because people are worried about the short term, and we're focused on the long term.
Currently in your portfolio, you have an overweight position in European equities. Can you please explain why? And also, have you been historically overweight in Europe, or it just so happened you find more bargains at this point?
So we have, in this portfolio, often been overweight Europe historically, and that's because we're often looking for income-paying companies, and Europe generally has a higher proportion of income-paying companies. And I should mention here that Europe obviously includes the UK as well. At the moment, particularly over the last sort of 12 months or so, we have found more opportunity in Europe. I think, though, what we should mention is that many of the companies that we're investing in, they might be listed in Europe, but they're actually multinational earning businesses, many of them with earnings in the US, in Asia, businesses that are growing really well, leaders in their industries. And so whilst we are overweight some European listed securities, I would not necessarily say that we're overweight revenue.
It's either European national or American nationality.
Yeah.
Are you seeing that the European valuation is lower than American valuation in the stock market?
Yes. Yeah. So European valuations generally are lower. That's been true for a long time. But the relative valuations have become quite extreme, we would say, in the last sort of 12 to 18 months. Look, obviously in the last 6 months, that started to compress back again. We've had many of the large companies in the US have underperformed quite substantially. And I think as investors have become more confident that some of the worries about Europe were perhaps overly exaggerated around the energy crisis and some of the political challenges, you've seen a recovery in those companies quite substantially, which has been obviously a helpful tailwind for us.
Are you finding it more difficult to find good stock to invest in a historical sense?
Look, I think it's become a little bit more challenging recently. I think if we look at the overall market levels are broadly in line with long-term averages. If you think about what's going on at the moment, obviously we've recently had a very significant change in policy in China, which has driven the reopening. So that's been an interesting sort of tailwind. I think if you take the example of the energy sector in the last 2 years, that was a sector which was very much out of favour, and obviously then the energy crisis provided higher oil prices and energy prices, and that drove the energy sector quite nicely. So there's always things going on, and by focusing very much on the bottom-up stock specifics, which we do, we can always find individual companies where something's happened, or perhaps they're selling an underperforming division, there's been a change of management, something's going on, and so we can always find opportunity.
Is there a certain sector or investment themes you like at this moment?
Well, look, I think one of the things we try to do is make sure that the fund is exposed to a number of different themes and factors. We don't want too much correlation within the fund. So if you look in the last 2 years or so, many companies were overexposed to growth stocks, unprofitable technology companies, and very much sort of story stocks. And many of those have they're down 90%, right? And very correlated as well. We want this fund to be quite uncorrelated, and so we minimise the level of factor exposure. Now, the way we do that is we focus on the individual securities. We run a correlation analysis to make sure that the companies aren't overly exposed to the same thing. I think with so much uncertainty in the world, we don't want to just have a fund that works for one specific reason. We want to diversify our sources of opportunity in the fund.
What is your average holding period for your investment?
We're pretty long term. So the average holding period of the fund is a bit over 3 years. And that's been pretty consistent for my career, which is about 20 years now. I've generally had around a 3-year time horizon. Look, there are many companies we'd like to hold for longer, but often the valuation kind of catches up with what we think is a fair price, and so we sell the position and we move on. There's always lots of new ideas. That's the great thing about being a global fund manager. Right. There's a lot to go at.
So you have a limited number of stocks in your portfolio, and you believe those stocks will deliver very good return over 3 years period. Having said that, though, what would you do if you find the better bargain than those that you are currently holding? What would you do?
I would sell something that we own, and I would buy the better bargain. We're not wedded to anything. We have high conviction in the companies we own. We like them, but our job ultimately is to make money for our investors and do the best job possible. And if we find something that is a better risk reward, absolutely it will go in the fund.
Okay. It is becoming, it is kind of obvious that we're going to have some kind of recession in the United States, which is a large part of global economy. Can the stock you hold in your portfolio endure the possible recession in the United States?
I think it's an great question. I think a lot of people have talked about a recession in the US for a long time now, and I think if I go back to say October last year, there was a lot of fear about inflation, interest rates, and a recession. And I think at that point in time, many companies were valued as such that they were already pricing in a recession. And so we were able to buy some companies, even in the US, for example, Ferguson, which we bought in the US. We recently bought a company called Celanese, which we feel these companies are already pricing in very significant cuts from a recession. So I think if we get a recession, I think provided it is not too significant and too large a drop in economic output, then I think many companies are already priced for that anyway, and there's an expectation for a recession. I think it's worth saying though that, as is in your question, I mean, there's a lot of uncertainty at the moment. The impact of interest rates. The consumer still has a strong balance sheet though, in aggregate. So there's a lot of moving parts to this, and at the moment it looks like whatever recession we have will probably be reasonably shallow, but things can change. And I think we need to be aware of that as investors.
Okay. Why should we invest in active fund versus passive fund? Can you please share your thinking?
Yeah, no, absolutely. Look, I think the last 10 years or so, from sort of post the financial crisis, has been really driven by liquidity, low interest rates, valuation expansion. There were a number of very significant US companies, the big tech companies, the FANG stocks, that really drove significant earnings growth in the US. And so you had, and obviously given the size of those businesses, those drove the market, very strongly. And it was a good time for passive investment, effectively, those 10 years. And I think a lot of those tailwinds that passive had are really now coming to an end. So I think obviously we've had interest rates picking up way more than the market expected. We've got inflation, which we expect to remain volatile. I think it's trending down, but it's going to remain volatile. And I think obviously the earnings growth that some of those companies were delivering and the business models have been very challenged. And in the last 12, 18 months, we've seen challenges to some of those big tech companies. So what we're trying to do is find companies that, for their own bottom-up idiosyncratic reasons, we believe are offering a strong asymmetry. And if you look at the portfolio, it's balanced across many different sectors, themes, geographies. We believe that this next 10-year period could be a really golden time for active fund management, because we can go and find the opportunities where they are. We think the volatility around macro sentiment will remain, and that should give us opportunities to generate alpha for clients.
I want to get your advice for the audience here. What makes a good investor? Can you please give us some advice from your experience?
Even if you're a really good investor, you won't get everything right. And you have to acknowledge that, and you have to understand when you're wrong, and you have to move on quickly. So you have to have conviction in what you're doing, and that means a huge amount of hard work. Understanding the companies you own, why you own them, and checking and rechecking that investment thesis. So, and I think the other thing, just for that's more from a kind of active stock picking standpoint. As an end investor, look, I think a really important thing is time in the market. There's often a phrase, don't try and time the market.
Right.
Make sure you invest, you stick with it, because none of us really know when the market will go up or down. It does tend to vary quite a lot. So invest, have a long-term view, and stick with it.
Some people, wants to time the market, believing that if you're right, sell high, buy low, and if you repeat that, then you make more money than holding the fund or stocks that they invest in. You're saying it's not a smart way to do.
Well, I think if you could do it consistently, it would be very smart. I mean, mathematically, it makes perfect sense. I think the problem is doing it consistently. It's very hard to do. Right. And if you look through the academic literature, you find that people who do try and buy and sell funds at different times actually end up with lower returns over the long term, because you can't consistently do it, because the time to buy is actually when things feel difficult, and the time to sell is probably when things feel great. Right. And that psychology is very hard for most people to manage. And so I think just find a fund that you like, that's sensibly managed, and stick with it for the long term.
So the key word is stay invested.
Stay invested.
Lastly, can you please share your long-term views for the U.S. stock market and also the global stock market? Are they going to provide us, very good return long-term?
Look, over the long term, equities have been a brilliant asset class. And I think the key point is if you can find companies with competitive advantages and pricing power, those companies that can grow and perhaps have new technologies, they dominate whatever industry they're in. Those have proven to be very good creators of value for end investors over time. Now, we discussed earlier, European valuations are generally lower than the US. However, I would say on aggregate, the US companies are often better. They have a higher return on equity. They really focus on driving shareholder returns through, share buybacks. They have a generally higher focus on return on capital. So, I wouldn't say, we should invest in this geography over the US. Actually, there are some, as I mentioned earlier, there's some wonderful companies over the next 10 years. But there are many companies like that. We have loads of ideas at the moment that we're working on. And that's always been the case for 20 years. I've never thought, what shall I do today? Because I can't find an idea. There's always something to do. And so, I remain optimistic about equity markets for sure.
Oh, Stephen, thank you for sharing your story this morning.
Thank you very much for your time. It's been great. Thank you.
Hope to see you again.
Absolutely. Thank you.